I'm sorry. I was just meditating on the more transcendental meanings hidden within the dividend discount models. Okay, it's enough of that. All right, let's continue on slide 21 with my favorite version of the dividend discount models, and that is the discounted cash flow model. This is, I believe, one of the best models for finding long-term oriented, boring companies that won't make us rich overnight, but should make us wealthy, assuming the world doesn't end. And the dividend discounted cash flow model, actually there's a few versions of this. We're using the one that concentrates on dividends. Is the present value, the value of the stock is equal to the present value of all expected future cash flows. So here's a little thing that looks mathematical, but it's actually very simple. You take the cash flow in year number 1, that's what the 1 stands for, and you divide it by 1 plus your discount rate, your required rate of return, your expected rate of return, desired rate of return. They all mean the same thing. And then in year number 2, you do the same thing, but this time you do the cash flow in year number 2 divided by 1 plus rate to the second power. And then in the year number 3, you get the cash flow in year number 3 divided by 1 plus rate to the third power, et cetera, et cetera, et cetera. Now, at the beginning of the semester, I promised you, you don't have to do exponents. And I'm going to keep that promise. But people who don't go through the presentations, who don't listen to the lectures, who are not remotely sober, will just, when they see the assignment, they don't even look at the book. They don't look at the presentation, watch the presentation, listen to them. They just try to use the exponential formula. And I say, it's mostly online students. I said, please go through the presentation, learn how to use the present value tables, because we don't want you to use the exponential formula. Some of you are very savvy and you can use them and do them correctly. Most people don't. And then I have to try to explain, you gotta do this, you gotta do that, but please use the present value tables. Anyway, let's continue. 3 annual dividends of $10 per share, and then 0 dividends from then on. So let's just assume this company is going to pay us 3 years of $10 per share dividends. So if our required rate of return is 7%, we would take $10 divided by 1.07 in the first year, and then $10 divided by 1.07 to the second power. 1.07 times 1.07. You got to do that first before you do the division. And in the third year, we would take $10 and divide it by 1.07 to the third power. That's multiplied 3 times. And if we do that, we get $26.24. And you say, well, wait a minute, Frank. Baiano, it's 3 years of $10. Isn't it worth $30? No, it's not. The reason it goes back to the present value, the future value of money. $10 a year from now is not the same as $10 today. $10 2 years from now is not the same as $10 today, and $10 3 years now is not the same. We have to discount that amount. What a horrible verb. We have to take those, but that's what we use. Get used to it. We have to take those future cash flows and bring them back to the present. But how often do companies pay 3 annual dividends and then promptly go out of business? Plus, we keep using this term, present value. What does present value mean anyway? Well, here's the crux of it, folks, on slide 22. We're not going to understand it just some of you will. Some of you get it right away. But other people go, well, I don't understand. Just do the calculations and don't worry about it. But here's how it works. We take the present value of a lump sum or series of payments to be received at a future date. And that tells us what's it worth today. What is the present value? It's the opposite of future value. The word in math we use is the inverse operation. Did you work on the optional future value calculations back in chapter 1? You didn't have to, but if you did, you went from the present into the future. Well, we're just doing the opposite. We're going from the future of future expected cash flow and bringing it back to the present. So let's say we have $10,000 today and we're going to get 10%. What do we expect it to be in 10 years? Well, there's the future value multiplier, $10,000 times 2.594. And we expect it to be $25,940, assuming we get the 10%. Well, what if we know we're going to get $25,440? Oh, we think we're going to get it. What is it worth in 10 years at 10%? What is it worth to us today? Well, it's worth $10,000 because there's the present value multiplier. And don't relax, I'm going to show you where we get these things from. And so that multiplied times the future value that we expect to get in 10 years gives us the 10%. So they're two sides of the same coin. In finance, present value tells us what the future value is worth to us today. And we said computing the present value is called discounting. I know it sounds dumb, but get used to it because that's the term you're going to hear in the industry. It has nothing to do with going to the store and getting a discount. No, it's taking that future expected dollar amount and bringing it back to the present. And doing the calculations is a whole lot easier than understanding the concept. Do the calculations over and over and over again, and the concept will hit you in the head like a brick one day. You'll just go, oh, I see, okay. What difference does it make whether I have this number now or that number in the future? They're the same. So did the formula scare you? The cash flow in the first year divided by 1 plus rate plus the cash flow in the second year divided by 1 plus rate to the second power. Cash flow in the third year divided by 1 plus rate to the third power. This formula has the present value calculation built into it. But we mortals simply use the present value tables to discount the future annual cash flows. Just as if you did it, we used the future value tables back in chapter 1. And so the formula becomes the cash flow in the first year times the present value multiplier in year number 1, plus the cash flow times the present value multiplier in year number 2, plus the cash flow in year number 3 times the present value multiplier. So PVM stands for present value multiplier, and we're going to just pull them off a table. That's all we're going to do. I promised you, you did not have to do anything other than add, subtract, multiply, and divide. And I ain't lying. You're just going to grab these numbers off the table. I'll show you the table in a minute. Okay, so here we go. Let's do the same example over again. We're going to use the present value multipliers from the present value table, and there's the link. I got it queued up here. 3 annual dividends of $10 per share at a required rate of return of 7%. So I got it over here. Here's the present value table. It's going to be in the packet for your full-time students. And here you go. You go across the 7%, 1, 2, 3 years. 0.935, 0.873, 0.816. So that's all you do, folks. You just grab those three values. Take $10 times 0.935, $10 times 0.873, $10 times 0.816. And so, $10 a year from now, if we require a 7% rate of return, of course, if we require a 10%, 12%, 8%, they're all going to be different. That's why everybody's different, right? So that $10 a year from now is worth to us today $9.35. That $10 2 years from now is worth $8.73. The $10 3 years from now today is worth $8.16. And you add the 3 up and you get the same value as the formula on slide number 21. What is the present value of the future stream of dividends? Well, it's 7%. $10 in 1 year is worth $9.35. In 2 years, that $10 is worth $8.73. In 3 years, it's worth $8.16. The sum of the present value of the future annual dividend cash flows equals our perceived value of the stock. Cool? And this is showing you what we just showed you. We go to the table on the website, and it's in your packet, and we grab the present value multiplier for year number 1, the present value multiplier for year number 2, the present value multiplier for year number 3, do the multiplications, then add them together, and we get $26.24. So we believe if this stock is going to give us 3 dividends over the next 3 years of $10, and we require a 7% rate of return, the stock should be worth $26.24. It's not hard. You do it over and over again, and then the concept will start to seep in you'll understand. I understand what I'm doing. I'm simply looking at that $10 a year from now and what is it worth to me today? Okay, I can do this. Slide number 26. Our example did not take into account that the stock will still have some worth at the end of the 3 years. I mean, we hope it does, right? We hope it didn't go out of business. To make the model more useful, we simply add our predicted market price of the stock at the end of the 3 years. And what happens is we treat the price of the stock at the end of the 3 years as a potential future cash flow. So then the formula looks like this. Value of the stock is equal to the present value of the future dividends plus the present value of the price of the stock when we plan to sell. Again, we use the present value multipliers. If you really want to use the exponential formula, please make sure you do it correctly, because I get really tired of trying to explain people, oh, you're not using the exponential formula correctly. You got to do the exponent first, then you do the division, and then you add it all up. As with the, and by the way, folks, after we've done these enough times manually, I'm going to show you a spreadsheet that does it for us, okay? So relax. Whether you use the present value tables or the exponential formulas, after you understand what you're doing, you don't have to do it anymore. You don't have to do the calculations anymore. The computer will do them for you. As with the other dividend discount models, this model is very sensitive to our estimates and our choice of required rate of return, and hence the results vary wildly. So let's say the current price of the stock is $125. Okay, let's just say it's $125. We predict the market price of the stock will be $135 at the end of the 3 years. So I like to make a table. I just think it makes it, which is a spreadsheet, folks, it makes it easier to visualize what I'm doing. So I got 3 years here, years 1, 2, and 3. The dividend of $10 year number 1, the dividend of $10 at the end of year number 2, and then the dividend of $10 at the year number 3, plus we don't know it's going to happen, but we expect the stock price to be $135 at the end of year number 3. So notice we have the present value multiplier for year number 1, the present value multiplier for year number 2, plus for the dividend in year number 3 and the expected stock price, the multiplier is the same because it's the same year. What some people will do is they'll put year number 4 here. No. That would be saying I'm not going to get a dividend in year number 4, and I'm going to sell the stock at the end of year number 4. That's you're changing the model. So this number has got to be the same. Notice that the present value multiplier for the dividend in year number 3 and the expected stock price at the end of year number 3 are the same. We are receiving the future cash flows in the same year, so we use the same present value multiplier. If you add all these things up, the model says that the present value of the future stream of cash flows from the stock is $136.40. The market price is only $125. So the model is saying, hey, this is a potentially good investment for us. Now, does that mean we should run out and buy it right now? No. This is just pointing us towards companies that we have to do a whole lot more research for. Make sense? Okay, so let's take a look at an example now. Pretzels Unlimited, PU, the symbol, is currently selling for $22 per share and will pay $2 per share in dividends in 2025. Pretzels Unlimited, they've been making pretzels for almost 100 years. They expect to increase their dividends to $2.20 in 2026, $2.30 in 2027, and $2.30 in 2028. We don't think they're going to, after next 3 years, they're going to sort of slow down. So we'll be selling the stock at the end of 2028, and we expect the price to be $27 per share at that time. Okay, our required rate of return is 12%. Well, we've set the stage. We've said we've given the dividends for the next 4 years and what we believe the stock price will be at the end of 4 years. And we've set up our discount rate, our required rate of return, our desired rate of return, our expected rate of return, they all mean the same thing, to 12%. So the value of the stock is equal to the present value of future dividends plus the present value of the price of the stock when we plan to sell. So where do we get the present value multipliers? From the present value table. We go to number 12, percent 12, and then go down years 1, 2, 3, 4, 0.893, 0.797, 0.712, and 0.636. Those are the 4 present value multipliers. So for the first 3 years, $2 times 893, $2.20 times 0.9797, $2.30 times 0.712. And then again, that same dividend, we think the dividend is going to stay the same in year number 4, $2.30 times 0.636. But now we also add the present value of the stock, predicted price, we believe, at the end of year number 4, $27 times 0.636. Notice these are the same. These present value multipliers are the same. So if you add all those, do all those calculations, you wind up with $23 and about 81 cents. So we believe the stock is worth $23.81 if our required rate of return is 12%. If you run it at 10%, it's going to be different. If you run it at 6%, it's going to be different. Exactly. Everyone has a different expectation of what their investments are going to give them. With a market price of only $22, the model is saying, hey, you know what? This looks attractive. This is a potentially good investment. Does that mean we run out and buy Pretzels Unlimited? No. It's just pointing us towards a company that may be a potentially good investment. We have a whole lot more work to do. But it's very cool, folks. You use this model and you're going to wind up finding very boring companies that won't make you rich overnight, but they also won't make you poor overnight, for the most part, but there's no guarantees. So now we're going to turn it into a table because that makes life a whole lot easier, in my humble opinion. We're going to put years 20, 25, 26, 27, 28, and notice that there's 2 entries for 2028. There are the dividends for the next 4 years, and then at the end of 2028, at the end of the 4th year, we'll put in the expected stock price, $27. Okay, we grab the present value multipliers from the present value table. Make sure you figure out where they come from. Slide. Percent 12. Boom, doing 2, 3, 4, 1, 2, 3, 4 years. And then we do the calculations, whatever that is, $2 times 0.893, $2.20, 0.979. I wish you would do it. We're going to do it in the class, right? 1.7534, $2.30 times 0.712, 1.6376, and then $2.30 times 0.636, $1.46. And then the $27 times the 0.636, notice they're the same, $17.17. And add them all up. And don't worry, you can round off. You don't have to be, we're not trying to be precise here. Gives us $23.81. So here is the problem in spreadsheet format, and I think it is much easier to comprehend and calculate in this format. Yeah, well, I hope so. I hope you think it is, because I do. But let's simplify it a little bit. Why don't we take that last year, where's that mouse? There it is. Take that last year and add the dividend and the expected stock price. Okay, so what we've done is we've simplified the table. It allows us to do one less calculation because we can add these 2 and then multiply, and we don't have to do the multiplication twice for the year number 4. And we get the same amount. Adding the dividend and the stock price in the last year saves us a couple of manual calculations. But more importantly, it allows us to use a very special spreadsheet function to calculate the internal rate of return. What is this internal rate of return? Well, the internal rate of return is a measure of what rate of return we expect to get from a series of cash flows, including positive and negative cash flows. In other words, what's coming in the door, but what did we have to pay to get to it? Someday, when you take an upper level or a graduate finance class or investment class, you will learn how to manually compute internal rate of return. Hopefully, you will not have a sadistic professor who will require you to calculate it manually more than once. It's not hard. It's just very tedious. It's a trial and error process that just takes a lot of time and a whole lot of calculations. That's why we have computers that do it for us. We're simply going to enter the numbers into a spreadsheet and press the enter keys. How does that sound? In other words, Okay, that sounds good to me. In other words, we required a 12% rate of return from Pretzels Unlimited. But what do our numbers tell us will be our expected rate of return? The computer can calculate it for us with the formula internal rate of return. So now, here's a spreadsheet. Now, if you haven't ever worked on a spreadsheet, folks, they're just like a big bingo calculator. That's all they are. A3, B7, C9. It's a big calculator. And hopefully you're going to bang away at the ones that we give you in the class because they're pretty easy to use. And then eventually you're going to say, oh, I can do this myself. So the spreadsheet formula is the equal sign. We have to start with the equal sign. IRR, which is internal rate of return. And then we give it the values, the block of cells containing all the cash flows, both positive and negative. What do we have to pay, right? And as well as what are we going to get. And then you can leave the approximate rate of return blank. You don't have to give it, but it's a good idea to give it a guess because what the spreadsheet will do is it'll use your guess and then try to find the real one. If you just leave it 0, it'll say, okay, I got to do it on my own. And sometimes the internal rate of return comes back with an error. It says, I'm sorry, I can't figure this out. So that's why it's a good idea to give it an approximate rate of return. So here are the cash flows. Here are the years. Here are the cash flows. And this is B1. This is A1, A2, A3, A4. Here's B1, B2, B3, B4. So we're going from B2 down to B6. And there are our cash flows. And so the formula is internal rate of return. Don't forget the equal sign. B12 colon B6. So from did I say B12? That's vitamin B12. B2, the negative $22, because we had to pay $22 to buy the stock, unless somebody gave it to us, right? We have to go out and buy the stock for $22. And then we get the dividends over the next 4 years, and we expect the stock price to be $27. So we added that together in the 4th year. And we put in the formula, and we put in a guess of 12%. We could have left it blank. The spreadsheet would have probably figured it out. And what the internal rate of return calculation is telling us is, look, if you pay $22 for this stock, and you get these 4 dividends plus the stock is worth $27 in 4 years, you're going to get 14.5%, 14.51. I mean, that's pretty darn good. I'd be happy with that. Would you? I'd be ecstatic with that. And so let's take a look at the example spreadsheet on the class webpage. And again, this is wrong one. Where am I going? I want to go here. Where did it go? Here it is, right here. Bingo. Okay. So there is the spreadsheet. Now notice it says view only. You're going to have to do file, make a copy to goof with it. And it says, hey, you're logged in over here too. Yeah, okay. That's the other one. That's the other me. All right, so what are we doing? We put in the gray areas. We put in the year, and it goes ahead and calculates the rest of the years. And this is for 4 years. We could do it for 3 years or 5 years, but we're not going to really do it for more than 5 years, and we'll show you why later on. There are the 4 cash flows, $2, $2.20, $2.30, and then $2.30 and $27. And notice, I didn't even have to do that. I could use the spreadsheet. I could say to the spreadsheet, hey, do equal sign $2.30 plus $27. And then it calculates the present value multipliers for us. It then calculates the present value of the cash flow. It then will sum up the 4 discounted cash flows are called. The present values of the 4 future cash flows, the discounted cash flows as they're called. And it tells us $23.80. Now, how come it's a penny off? The reason it's a penny off is because the spreadsheet doesn't just use 3 digits here. It shows 3 digits, but it's actually using 20. Computers use 20 digits of accuracy. So, it's a penny off. So we put in the current market price, and don't forget to put in your expected rate of return. And the cool part is all you got to do is change the expected rate of return to 10% or 13% or 6%, and the spreadsheet recalculates for you. Is that cool or what? Yeah, I think so. Here, so let's read what I wrote here. Okay. The discounted cash flows are the cells here from E4 to E7. And yes, this is a potentially good investment for us. We calculate that the present value of the future cash flows from the dividends and the sale of the stock is approximately $23.80. However, the market is only asking $22 for a share. So we believe we can buy $23.80 of value for only 22 bucks. But always remember, we are simply identifying good potential investments. We must do much more research and exercise sound judgment when selecting a company to invest in. I got to change that. I did Department of Redundancy department there. Okay, so now let's go. Okay, you can't see this. I'm going to make it. I'm going to get it and get it. Oh, come on, sweetheart. Come on. Oh, there you go. I didn't show the bottom. Spreadsheets are very cool. They can have more than one sheet. So this is the present value sheet, but notice if I click on here, it's like a notebook or a tab. You click on internal rate of return. Come on, click on that. Click on. And so it grabs the data from the previous spreadsheet and calculates the internal rate of return for us. It's already done, right? It's already done for you. That's cell C4, because I started at C4, down to C8, and I put in the 12%, but again, you could leave it at 0 and it'll probably figure it out. Now, is this cool or what? So what you're going to do, dear students, is you're going to do these manually in worksheet number 1, in worksheet number 2, in the assignment, and the exam. You do them manually enough times, and then you're okay, I'm ready to use the spreadsheet. Okay, let me use the spreadsheet. And so, yeah, and then maybe you already understanding it, maybe you don't, but then you're going to understand what you're actually doing. I am taking values that I expect to get in the future, and I am bringing them back to the present and assigning a valuation to them. Now, do we really think we're going to get these values in the future? Well, maybe, probably not, especially the future stock price. And that's why we say we are only pointing to companies that may be potential investments. We're putting our finger up in the air and seeing which way the wind blows. This is not a guarantee, right? Because if it were, everybody would be doing it. Everybody would be making a gazillion dollars, and it just doesn't work that way. Slide 33. Genes are us. Have you heard the joke? What did the one chromosome say to the other chromosome? Do these genes make me look fat? That's a biotech joke. It's currently selling for $21 a share. They pay no dividends. In fact, they're not making any money. They're the biotech startup. We believe that Genes R Us will sell for around $50 per share in 5 years. Our required rate of return is 13%. How can we determine if this is a potentially good investment? Well, with no dividends, we can't use the zero growth model. We can't use the Gordon growth model. But we can still use the discounted cash flow model. Why? Because we're treating the price of the stock as a future cash flow, as if it were a dividend. The present value of the dividends is 0 because there's no dividends. That makes life a whole lot easier, right? No calculations. But we say, what is the future expected stock price? Let's treat it like a dividend. In 5 years, we expect to turn around and be able to sell the stock for $50. So what are we going to do? We're going, our required rate of return is 13%. We're going to run over to 13%, go down to 5 years. There it is, 0.543. And we multiply the $50 expected stock price in 5 years times 0.543. And that gives us $27.15. Stock selling for $21. So the model is saying, hey, it might be a good investment, but is it speculative? Oh, yeah, there's no dividends. There's probably no earnings. And who knows if the drug they're trying to make is ever going to make it to the big time. Who knows? It might turn out that it turns people's liver into pate. And so that's, there goes $600 million down the drain. So let's apply the same 2 spreadsheets that we looked at for Pretzels Unlimited to Genes R Us. With a current market price of $21, we expect the stock price to be $50 in 5 years, and it pays no dividends. So here's the discounted cash flow model. 0, 0, 0, 0, 0, and then all of a sudden $50 times the present value multiplier for 13% at 5 years, and that gives us $27.15. And the internal rate of return, we pay $21 today, and in 5 years we get $50, and the internal rate of returns between B2 to B7, and we put in 0 because we weren't sure, tells us, look, if you do pay $21 for this stock and you get $50 in 5 years, you're going to get almost 19%, 18.95% return on your investment. Okay. Can you see the difference between a company that's been around for over 100 years selling pretzels and a company that's trying to create a drug that may never come to market, spending hundreds of millions of dollars? I hope you do, because if you do, you've been paying attention. The Pretzels Unlimited stock is a whole lot less volatile, a whole lot less dangerous than the Jeans R Us stock. Now, am I trying to say you should never buy a Jeans R Us stock? No, that's not what I'm trying to say. What I'm trying to say is it shouldn't be the vast majority of your choices. For every one Jeans R Us, how about having 4 or 5 Pretzels Unlimited? Does that make sense? I hope so. Look, and also, let's read together. You can't leave Business 123 without knowing how to compute the Gordon growth model and the discounted cash flow model. It's bad for my self-esteem. And they're going to be on exam number 2. They're going to be exam number 3. They're going to be exam number 4. They're going to be on the final exam. You are going to be thoroughly immersed in this model. And then after you leave, there are dozens of others that you can start playing with. When you find one that is better, at least for dividends, please let me know. We'll also take a look at a very powerful tool called the Stock Selection Guide through an entity called Better Investing. And we had at least one student go to that, and that was a pretty amazing lecture, and maybe we'll get her to come tell. I can show it to you, but she knows it inside out. Okay, so please learn them now, study the worksheets, contact me for help, do the problems over and over and over again. There's answer keys, commentaries, and please don't use AI to do the problems. We're going to show you a spreadsheet. I already showed you a spreadsheet. Once you've done it enough times manually, you use the spreadsheet and life will be good. Slide number 35. Okay, are these the only models out there? I already told you, no, there are many others. Residual income model. It's basically the Gordon growth model, right? But instead it uses earnings in place of dividends. And then there's the free cash flow model, which uses cash flow. And then there are the price ratio models, which use the various price ratios that we'll take. We already looked at one, price to earnings. We'll look at others in the next in the next chapter. There are many valuation models. You have the rest of your investing career to explore them. Please contact me when you find one that's better than the discounted cash flow model for dividend-producing companies. One of the best models, as we said, is the betterinvesting.org Stock Selection Guide, and we'll take a look at it maybe sooner than later. It depends how much time we have, and maybe we'll get an expert invited lecturer to come in and show it to you better than I can. But it's really actually pretty simple. This is very, very complex, and there's a whole lot of, it's like an onion, as we've said. You peel away. On the surface, it looks pretty easy, but then you start peeling away things, and you go, oh my goodness, there's a lot of complexity under the hood. So, slide number 36. Okay, Piano, this is all great, but just where are we supposed to get all this historical information anyway? And just who decides what next year's earnings or dividends per share, dividend growth rate, etc. are going to be, let alone the expected price of a stock in 3 to 5 years? Well, before the internet, this information was not readily available. Normally, you'd go talk to your broker and ask your broker for it. Or you would use one of the trusted information sources available in the securities industry, and traditionally the most respected source, and I still think one of the best, was the value line. And that, dear students, is the theme of our final presentation in Chapter 4 when we return. Yours truly doesn't do anything without consulting the value line. I don't even go to the bathroom without consulting a value line. That's how important it is to me. But there are others. Morningstar is trying to get in their cookie jar. And then there's an older one called, used to be Standard & Poor's, now it's CFRA or CRFA or something. They were never as good, and I still don't think they're as good. And I don't think Morningstar's, we can argue over that. But in our final presentation, dear students, we will take a look at how we can use the value line to populate these models that we've created. And you are now official investment gurus. You now look at an investment very differently. You look at it from what the cash flows it can return to us in the future. Not, is it going to be, we buy it for 10, it's going to be $12 next week. No, you don't look at it that way. You look at it, what is it going to return to me over the next 3, 4, 5 years? I hope so. I think so. Welcome to the temple of the dividend discount model, dear disciple. You have been elevated to the position of official investment guru. It is a very weighty responsibility. Thank you so much for being in our class.